Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I have had a few requests to check out AMD. AMD has come down quite a bit over the last few months. So if we look at the year to date, it's actually 14% down. For the 1 year, it's actually 8% down. I couldn't believe when I actually completely have not looked at AMD in ages, and I haven't paid too much attention to it up until now. I'm like, wait, a year to date is down 14% when everything else is going to the moon. I thought this was one of the companies that will benefit from the AI madness that was happening. I was too focused on Broadcom and the fact that Broadcom is being absolutely crazy. I don't even know how much. Let me actually see Broadcom. I think we did a video a couple of days ago, but since then, for the 53% for 1 month. How much is up? 41% in the last 5 days. That's not even normal. That's ridiculous. Genuinely, that is okay. That's crazy. But the company we're going to talk about today is AMD, and please just be careful with these companies. There's some of them out there right now. They're killing it, but it's just the valuation is ridiculous. Okay, we might be heading the bubble, territory kind of thing. But year to date is down 14%. And when basically one of the brothers asked me on the Discord, on the Patreon account, I thought, you know what, let me just have a quick look. And then I saw 14% down a year to date. I was like, that doesn't make sense. So right now it's trading $126 per share. It's very, very close to the 52-week lows. At one point, it was trading $227 per share, which is mad if you think about it. That's about closer to $100 lower than where it was. Okay, so what we're going to do now, we're going to look at the financials of the company, and we're going to look at, of course, basically the discounted models, and then basically tell you exactly what I would be doing moving forward, inshallah. I looked at the second Morningstar valuation, and it's a 4-star stock, and that's another surprise that I got. That's 21% basically discounted right now, which is interesting. So let's have a look at the more details about the company. We'll go to the financials first, because that's the important part. So we are focusing on total revenue here. We've got $5.5 billion in 2014 to right now $24.2 billion. And they're basically spending about $11 billion to actually make that revenue, and about 12.6 of that is actually gross profit. Now, after they do some research and development, selling and general administration, all of these things, they pay some taxes and all of that stuff. The net income is $1.8 billion from that, for basically $12 billion, which is quite low, to be honest. So they must be spending a lot of money on maybe research and development, to be honest, itself is 6.2. And this is why these companies, they have to innovate. They have to stay innovative company. Otherwise, they'll be out of the game, just like Intel. I don't even know what's happening with Intel. It's going crazy. And 2014, this company was losing money. Up until 2018, that's when they start becoming a positive. And then quickly, as you can see right now, is they've done well up until 2021. 2022 not so great, and then 2023 is right now is basically a bit of a decline, but the trailing 12 months is basically $1.13. So it is up and down. It's a very cyclical business. We know that already, because semis are generally like that. So this company, if you don't know, actually basically is one of the biggest players when it comes to semiconductor industry. They specialize CPUs and GPUs. They've got very well-known products that basically are used in, for example, laptops and gaming devices and personal computers like laptops, servers, gaming consoles, and so on. So yeah, they have all sorts of products that basically the company sells. Now, just going back to the balance sheet, which what we want to see is the current assets of $18.7 billion. Against the current liability, total current liabilities of $7.5 billion. So they can easily cover, okay, because they've got 18.7 total current liabilities and total current liabilities of $7.5 billion. Total liabilities of 12.6 in comparison to total assets of $69 billion. So they're fine. There's absolutely nothing wrong with the company when it comes to that side of things. Now let's look at a bit more detail about the company. Right now the company is actually over 205 billion market cap. It has a narrow economic moat. In terms of EPS, about 113 right now. The forward PE is about 39, and the 5-year average is 53. So based on that, it seems very expensive. The sector medium is about 25 right now. Free cash flow of $1.5 billion. Free cash flow compound annual growth rate of 105%. Free cash flow margin of 12%, which is good. Now, in terms of profitability, as you've seen it already, the company has basically not had that many years of positive earnings and so on, but it is okay. It is heading the right direction, I guess. Over the next whatever years, we'll see how it what that becomes. The net income margin compound annual growth rate, we're looking at about 11%, and total return in the last 10 years, we're looking at 48%. Revenue compound annual growth rate of 32%, EPS about 43%, and we've already seen the fact that they've got enough assets to cover the current liabilities and so on. They're expecting the EPS to grow, basically the revenue to grow about 27% and EPS to grow 54%. I wasn't sure that if let's go back here, let's check this out. Okay, so this is where it's coming from. The revenue about 27%. Okay, in 2025, 2023, 23% in 2026, and 18%, and so on. So if we just look at the first four, and then the same things for here, 25% in 2024. I think that's we almost finishing the quarter, and then we've got 53% next year, 38%, 29%. That's huge if you think about. Okay, in terms of Morningstar valuation, they're saying it's about 18% discounted right now. 100. In fact, let's go back here. What did it say? 21%. So I just need to update that, by the way. But yeah, so you can see they're saying it's about 18% discounted right now, or 21%. In fact, we can just change that quickly. 21% discounted right now. $160 per share is where they think the price should be. Check this out. Simply Wall Street is actually saying is a 42% undervalued at the moment, and they think basically the price should be $222 per share. Now, tip rank is actually saying 184, 46% upside from where we are, a moderate buy. Average price from Seek and Alpha, $184 per share, and that's 48% upside from where we are, and that's a buy as well, which is crazy. So everyone here more or less agreed the fact that the stock is actually undervalued at the moment. So in terms of Sharia compliance side of things, absolutely nothing to worry about. Ordering shares have basically increased, and this is one of those companies that like to use it. I think it's basically 1.2 to 1.6, and that's where it is at right now. And they have bought back some of their shares over the years, and basically they're paying some debt off. Free cash flow basically from in the millions to right now 1.6, which is not bad. At one point in 2021, I think it's $3.2 billion of free cash flow. Then that slightly declined over the years, but right now it's 1.5. So we've seen that already, 1.6 or whatever it was. So that is basically just to looking at the financial side of things of this company. Let's now compare this with the S&P 500 and of course other companies in the similar sector. So we're going to choose Qualcomm. Okay, we'll select this one and maybe Broadcom as well, just for the fun of it. Okay, and then we will select the performance total return. That's what we're after. And we will check for the last 3 years. So AMD is actually has declined over 8% over the last 3 years. The S&P 500, actually, if you bought the index, basically you will be up right now 30%, and this one you will be down a lot. And this is one of the reasons why sometimes it's better to invest ETFs that are more or less track the S&P 500, then especially with the Sharia compliant ones anyway, than actually buying the individual stock, because there's a massive risk for buying something like this. I would genuinely buy the Investco ETF rather than actually this, because personally you're actually taking a huge risk, and if over the last 3 years you would actually have beaten this company, you might as well just buy this, basically the index if you want. And same goes for Qualcomm. It's actually down for the last 3 years, which is interesting. TXT or Texas Instrument is about 10% up. The Micron is up about 33%, and Broadcom is up 332%. I shouldn't even have included that one here. And then the next one, basically, we look at 5 years. So 5 years, you would have made about 200%. Then the S&P 500 is just 90%. So if you hold this for the last 5 years, you would have actually made good money. This stock was trading about $40 per share when I bought it, and then I sold it when it got to 80 or 90. I can't remember. In 2020, it was just ridiculous. And since then, I've actually haven't gone back into it. But for the last 5 years, you would have made 2%, 200%. Qualcomm about 100%. Texas Instrument about 71%. over 100% when it comes to Micron, and of course this one is the crazy one. For the last 10 years, let's see, 4,800. The S&P 500 is basically 192, and the rest of them you can just check that out. But yeah, this is one of the reasons why sometimes it's better to buy individual stocks, but again you're taking a massive risk. So if you own this stock for the last 3 years and you haven't made anything, you're probably thinking right now, why do I still have this company? I'm gonna sell it. Because of that, psychologically it's hard to keep a stock in your portfolio knowing that it has done absolutely nothing for you. I do have some of those in my portfolio, and sometimes I look at them, I'm like, should I be selling this? Should I be holding on to it? And then I go back and say, has anything changed in terms of my thesis? Has anything changed? Is the reason why I bought this stock in the first place is still there? And if the answer is yes, then fine. Has the fundamentals changed? No. Is the company still making profit, still selling products that are in demand and so on? Yes. Then of course, then I leave it alone. But if any of these questions is a no, then of course, then you might as well just get rid of it. Opportunity cost. Remember that. Just sell it and then buy something else that will give you a better returns in basically in the next 5 to 10 years, inshallah. Right, final thing we're going to talk about is this part here. So we got Morningstar valuation, we got Seeking Alpha, we got Simply Wall Street, the discounted cash flow model that we used. Average all of them out, $184 per share. Right now it's 126, 46% upside from where we are. If you say this is a very volatile company, I want a 20% discount, $147 per share is potentially what you would be paying for. It's still undervalued. My main concern for this company is genuinely the fact that it's very volatile stock. It goes up and down like crazy. I'd rather buy in other companies within this sector that are a bit more stable, the Qualcomms and so on. And the PE is very, very expensive right now. But in the long run, this is one of the companies that, because of the fact that Intel has not done anything over the last whatever years, it benefited from that. I don't know how long that's going to continue, if they can actually maintain. Their server products are quite good. Their games and all of that is absolutely amazing. I don't know if they can continue that trajectory, and if they can, that potentially that may be better for, in terms of the expectations moving forward. It's telling us that they will continue doing this, but again, these are based on these 40 something analysts that probably have a bit biased, whatever. So I would be careful. Personally, I would rather buy Qualcomm and just sleep well at night than actually buying this one right now. So for me, it's a pass. But potentially, if it keeps going down below, if it goes below 100, then I might start looking at it. And it can happen, by the way. There was a point, like I said to you guys early, this stock was trading about $40 per share, but that was about 4 years ago anyway. So I'm going to stop the video here. If you're interested in this company, of course, do your own research, find out a bit more information about the company, find out exactly where the demand is basically for this company, because if the products that they're selling right now, especially these products that they sell to companies like Microsoft and so on, if there's still a massive demand for these products, then of course potentially you might nibble it, just add a little bit here and there. But of course, always do your research, inshallah. I'm going to stop here. Have a wonderful day. Assalamu Alaikum.